All right, today we're going to get into a real financial perfect storm, one that completely reshaped an entire continent. We're talking about the 1982 Latin American debt crisis. It's really a story about big ambitions, huge global shocks, and some really painful lessons about just how connected our world is.
So, how did just one person's decision manage to plunge an entire continent into crisis? I know it sounds dramatic, right? But that question, it really gets to the very heart of what we're exploring today. We're going to unpack exactly how a single policy choice made thousands of miles away could set off a financial meltdown that basically defined a whole decade.
Okay, to really get this, we've got to rewind the clock. Let's go back to the 1970s. Now, this was a time of massive, and I mean massive, borrowing all across Latin America. You could say the storm clouds of the crisis were definitely gathering, even if nobody was really paying attention to them just yet.
So you might be asking, why borrow so much money? Well, you have to understand, at the time, the reasons made a lot of sense. For one, these nations were funding some really ambitious infrastructure projects. Think new roads, dams, power plants, the whole shebang. They were also using the money to cover government budget deficits, and, importantly, to pay for really expensive imports after the big oil shocks of the 70s. And, the cherry on top? Global interest rates were at rock bottom. So borrowing just seemed like the smartest, easiest way to grow.
And this is where you see that classic double-edged sword, right? On one hand, the promise was huge. You could finance all this new infrastructure, you could supercharge economic growth. But, on the other hand, a really big problem was quietly building up in the background. Countries were just racking up these massive amounts of external debt, and that left them incredibly vulnerable to any kind of global shock. Plus, to make things even trickier, many of their currencies were overvalued, a kind of hidden weakness that was about to become a massive liability.
And that liability, it has a name. It's called capital flight. The idea is pretty simple, but the effect is absolutely devastating. Basically, when investors get spooked and think a country's currency is about to tank, they pull their money out, and they do it fast. It's like a bank run, but for an entire country. This mass exodus just drains a nation of the foreign currency it desperately needs, and it often becomes a self-fulfilling prophecy, It triggers the very crisis everyone was afraid of in the first place. So definitely keep that term in your back pocket. It's going to be a huge player in this story.
So, you've got this simmering vulnerability, right? How does that actually explode into a full-blown crisis? Well, the trigger, the thing that lit the fuse, came from a place nobody was really expecting. That stable, cozy, low-interest world of the 1970s, it was about to get shattered by what was basically a lightning strike coming straight out of Washington, D.C.
And here's the man and the decision at the center of it all. To fight runaway inflation happening inside the United States, the chairman of the U.S. Federal Reserve, a guy named Paul Volcker, made a really drastic move. He jacked up interest rates. Hard. Now, you got to remember, this was a domestic policy. It was designed to solve a domestic U.S. problem. But the shockwaves, they went global.
And this shift, it was incredibly sudden. We're talking about years and years of Latin American nations borrowing money, working under the assumption that these low interest rates were just the new normal. And then, bam, almost overnight, the cost of borrowing money on the global market just shoots through the roof. It left them completely, totally exposed.
Yeah, and to really understand the impact here, just think about your own life. Imagine you have a mortgage with a variable rate. Many of these loans did. It would be like waking up one morning and finding out your mortgage payment had suddenly tripled, maybe even quadrupled, overnight. Now, imagine that happening not to a person, but to an entire country. That's exactly what happened. Their debt payments just exploded, and they became absolutely impossible to manage.
So, with these debt payments suddenly out of control, that financial time bomb that had been ticking away quietly for a decade, it finally went off. And the crisis didn't just trickle in. It hit with breathtaking speed and incredible force.
What followed was just a brutal chain reaction, a real domino effect. Okay, so first, U.S. interest rates skyrocket. That makes the debt payments for these countries impossible. Then, remember that term, capital flight? Well, with much higher, safer returns now available in the U.S., money just flooded out of Latin America. That, in turn, crashed their local currencies, which, and this is the kicker, made their debt, which was in U.S. dollars, even more expensive to pay back. The final domino to fall was inevitable: widespread default. And the fallout was immediate and just catastrophic. It touched every single part of the economy. We're not just talking about numbers on a spreadsheet here. For real people, this meant a deep, painful recession. It meant their currencies were in total freefall. It meant skyrocketing inflation that completely wiped out their life savings. It was, for all intents and purposes, a complete economic collapse.
And we're not talking about small, minor economies here. We're talking about the heavyweights of the region. Mexico, Brazil, Argentina, all of them were forced to default on their debts. And that sent an absolute panic through the entire global financial system. Because now, all the big international banks that had lent them all that money, well, they were at risk too.
Okay, so to stop a total global meltdown, the financial firefighters had to be called in. That's the International Monetary Fund, the IMF, and the World Bank. They stepped in and offered these massive bailout packages, but, and this is a huge but, the money came with a lot of strings attached. Very, very strict conditions that were known as structural adjustment programs.
And that intervention, well, it really marked the beginning of a long, incredibly painful period of recovery. It's a period that's now known across the entire region as the lost decade. The crisis left this deep, deep legacy of social pain. But at the same time, it also forced some really fundamental economic reforms.
And the social cost? Wow, it was immense. Those austerity measures demanded by the IMF, they meant governments had to slash spending on things people rely on. We're talking healthcare, education, social programs. This led to massive layoffs of public sector workers, a huge drop in living standards for almost everyone, and widespread poverty. And all of that, of course, fueled a ton of social and political unrest. For the average person, it was just a brutal, painful decade to live through.
But, out of all that pain came this forced economic reset. With very few options left on the table, these countries began a pretty radical transformation. They started opening up to global trade and investment, they privatized a lot of inefficient state-run companies, and they adopted much, much stricter financial policies. The whole goal was to build more resilient economies that could, hopefully, prevent a crisis like this from ever happening again.
So what it really boiled down to was a fundamental change in economic strategy. With investor confidence completely shattered, countries shifted their focus away from those risky short-term loans and towards attracting more stable foreign direct investment. Since it was so expensive to borrow money from abroad, they were pushed to develop their own domestic capital markets, and finally, that shared trauma of the crisis, it actually led to much greater cooperation between the countries in the region.
And that really brings us back to today, doesn't it? The story of 1982 is such a powerful reminder of how a decision made in one part of the world can create massive waves everywhere else. And it leaves us with a pretty critical question to chew on. In our world today, which is even more interconnected financially, have we actually learned the lessons we needed to? Are we safe from another lost decade? That's definitely something to think about.